let's move on to our next guest here. You know, it is my core belief that everyone should have more real estate in their portfolio. So let's bring on, there he is now, Joseph Coradino, the CEO of Pennsylvania REIT. We're at a round table here. What's up, guys?
Good afternoon.
How are we doing today?
We're doing good. To my left,
so we've got Joe. We've got Coradino. Joe. We've got Ellery, correct?
Joe Coradino.
Joe Coradino. And
Rescue, the CFO.
And Heather Crowell.
Awesome. All right, guys, I see your slides. Can you just put them in present mode, please? And we'll bring the slides up on the screen. And then we'll pull them up and then we'll roll. Because I see your slides now, and if you could just put them in present on the PowerPoint on your end.
We're having a slight technical issue, but we can walk through the slides, and in a moment we will pull them up.
The good news is we can still see them as they are.
Oh, okay.
So when you kind of go into present mode, go for it. But otherwise, we can still. I mean, I can read it on my screen. So if I can read it, I'm saying it's good to go. So why don't you start rolling through it and
sure,
and we'll go.
Why don't we take you through it?
Awesome.
So, I mean, Preet is an owner in 19 high quality malls that we have transformed, that continue to transform into community hubs. Our portfolio is concentrated in the Mid-Atlantic with a strategic focus on Philly and DC markets. And to the extent our assets are not in those markets, we tend to be the strongest property in the market. We like to call it the last man standing. Our portfolio is sized so we can dive deep into every asset, but it's strong enough that we can attract a diverse array of businesses and drive strong traffic and sales to our properties. I mean, all things considered, business right now is excellent. We think we've been able to see around corners and value our portfolio of irreplaceable real estate. We've recognized the changing landscape, and today we're really focused on 5 core areas of growth for our properties. Multifamily and hotels, apartments are a big part of our future. Healthcare and wellness, groceries and essentials. We're adding tenants like Whole Foods and Aldi to an enclosed mall environment. We're doing experiential tenants, entertainment, etc. And of course, retail remains at the core. And we have a history that is that's rich with action, as the slide indicates. We like to think that we carefully curate to best serve our communities. Again, we're sized to be able to really drill down into the assets, understand our markets, our properties, our customers. And with Philly and DC, we're a compelling opportunity for retailers, for multifamily, for all the things that are contributing to our continued growth. And the way we got here, by the way, there's a lot of talk about the death of malls and we're over malled, etc. And to a certain extent, we don't disagree with that. We got here by selling off over 19 lower productivity malls in secondary markets. So what's remaining is quality assets. And the other issue that's gotten a lot of attention on the scene is department store boxes or anchor vacancies. We've replaced over 19 anchor boxes with 36 new tenants, with a differentiated tenant base that is comprised of 30% of the kind of tenants you'd find in an open air center. So we've enhanced our credit quality. We've got better credit in those department store boxes, and we've increased the traffic and sales coming out of those properties, and thereby the traffic and sales in the malls themselves. So we were destined not to be victims of this shrinking department store landscape. And when you look at what we've done, those 19 anchor boxes filled with over 30 tenants. We're generating 3 to 4 times the sales volume and creating new traffic flows. So the tenants we have that we replace the likes of Sears and JCPenney with are Burlington, Dick's Sporting Goods, Home Goods, Yard House, Aldi, Whole Foods, greatly enhancing the underlying credit of our portfolio. And we like to think that the size of our company and the footprint really enables us to be nimble and respond to the changing needs of each of the markets we serve. We have the unique ability to tailor and to pursue innovative new opportunities. And we got a great example at Moorestown Mall where we took a Sears store and it's going to be replaced by an outpatient facility operated by the Cooper Health system. That it really is a differentiated tenant that will drive traffic to the property, but is certainly not a retail use. We also received approval at Moorestown to build over 1,000 apartments, and we're close to final approval on that as we speak. So the work that we have done has really added value to the portfolio and has positioned us for future growth. We also focus on cultivating retailers, small and emerging businesses that have been choosing our properties in droves, driven by the efforts of our teams and the market positioning of our properties. Our local leasing is set to yield double the volume it did in 2019. Double the volume in 2019. I'm skipping 2020 for obvious reasons, but comparing it to 19, double the volume. We brought in some unique shops and pop-ups, from yarn vending to fidget toys to baked goods, on and on and on. Our programs have been so successful that we expect to have fully occupied inline cart and kiosk space in over 60% of our properties this holiday season. It's our belief that these merchants are selecting our locations for their businesses because of the quality of the assets within the markets they serve. Now, if we look at the operating highlights, we've had a strong third quarter. Rolling 12-month sales grew by 6.1% compared to rolling 12-month, again, in 2019, standing at $581 a square foot on a comp basis, a traditional measurement for our business. Our total core mall lease space remains strong at 91.7%. And there are 637,000 square feet of leases signed for future openings, which will contribute annual gross revenue of about $10 million. And those tenants include entertainment concepts and restaurants, etc. Again, the properties are seeing significant growth in our leasing volume. If we look at Q3 21 financial highlights, more recent results from the quarter, same store NOI excluding lease termination revenue increased 36%. Yes, 36% for the 3 months ended September 30th, 21. Total liquidity was strong at $96 million at the end of Q3, and collections continue to improve to 92%, up during the quarter, up to 93% for October. And recently, we have very exciting tenants that are opening. We're opening a brand new theater in Grand Rapids, Michigan at Woodland Mall, one of our premier properties, a dine and recline concept, as we like to call it. We've welcomed our first Aldi grocery store at Dartmouth Mall. Now, this is an interesting one. Adding a food store, one can think about it and say that, geez, you won't go food shopping and go to the mall. But our traffic during weekend of opening of the Aldi store increased 33%. 33% increase in traffic inside the mall. We opened up Tilt Studio, replaced a JCPenney at Magnolia Mall, which is a very exciting multimedia entertainment concept. We've got some online tenants coming in. Warby Parker, Amazon 4-star, signed leases at Cherry Hill Mall and Turn 7. A hot new concept is opened up this week at Moorestown Mall, validating our merchandising strategy of adding unique first-to-market retailers to the malls this holiday season. If you look at our balance sheet, and that's a real focus of ours as we've continued to recover from COVID. It's critical that our operating results are doing well, but we need to improve our balance sheet. Toward that end, we announced a plan to raise over $120 million by the middle of 2022 through the sale of multifamily land sales, hotel land sales, out parcels, and other uses. So again, big focus on the balance sheet, progress being made in terms of entitlements and anchor approvals in order to be able to execute on raising the capital to improve our balance sheet. With that, I'll pause for a moment and open for questions.
Yeah. I've actually got a couple questions myself here, and then there are a few from the chat. What do you say to the people that are just like fundamentally, maybe they've been scarred from the last 2 years or whatever, but they're just fundamentally like just against the physical space, right? Physical retail, mall-based, all of it. Just what would you say to those people?
Well, I would say that a couple of things. One is, sitting at home in your pajamas and shopping has got to get old after a while. That's the first thing I would say.
You would think so, wouldn't you?
The second thing I would say is that, again, we're seeing dramatic increases in sales at our properties. Restaurants are doing business, retailers are doing business. I just came back from an in-person International Council of Shopping Center meetings where we met with all of our retailers. Retailers are in a brick and mortar space are doing fantastic right now. But the other point is that I don't think they're mutually exclusive business models. There's a reason that, we're opening up an Amazon 4-star and we're opening up a Warby Parker and a Purple. And that is that there's brand exposure that one can get from a brick and mortar store that's valuable, number one. And number two, eliminating the cost of shipping through things like buy online, pick up in store are critical. I mean, Amazon can get it to you tomorrow. We can get it to you today. Right. And that's the difference. Right. And that's an important difference. I think also as we look at this holiday season,
I was going to ask you about the holiday season, and that was my next
go
point.
ahead. I'll
pause
for a moment.
What are you seeing, this past month?
Well, I mean, we're extremely optimistic about the holiday season. I was looking at a JP Morgan study. Consumers have amassed $2.5 trillion in savings during the pandemic lockdown. And I'll tell you, if we look at our sales, which is up in the mid to high teens, people are out shopping, no question about it. They're out shopping. And part of it, by the way, is the fact that, that there is a shortage of merchandise given the shipping crisis that we're underway. And you can go see it, touch it, buy it, take it home, as opposed to order it and get a note that says it's out of stock. So we're really seeing very positive results in the portfolio. And again, that probably is best illustrated by the fact that we'll lease over double the amount of space this year than we did in 2019. Again, not in 20. That's an easy one to beat. We were closed for 4 months in our portfolio, but compared back to 19, we'll lease over double the space.
Let me check on the time here. I think we have time for one. Yeah, we got a couple more minutes here. Great. So, question in the chat. If you have any questions, drop them in there. Question about your debt to equity ratio. Can you address that?
I'm going to ask Mario Ventresca, our Chief Financial Officer, to address that.
Yes. Good afternoon, everybody. It is obviously, as Joe pointed out, a focus of the company to improve our balance sheet, and the corollary of that is obviously improving the debt to equity ratio. The initiatives that he laid out on the last slide that he spoke to, in terms of harvesting capital, obviously that will lead to significant improvement in the balance sheet. We have a number of asset sales underway. Through these efforts, we expect to close on the sale of 12 parcels for over $120 million in gross proceeds. These will close by mid-2022. This includes the sale, again, as Joe had said, of several parcels of multifamily land, which are currently vacant parking fields, at our assets. We have $99.1 million under contract for those parcels under phase one.
And there was, I know you had mentioned the dividend. I believe you said early next year, correct? Is that what was said?
No, we didn't. We did not mention the dividend.
You didn't? I apologize.
That's okay. We're precluded from paying a dividend under our current banking arrangement.
Okay. I would imagine you will give an update when there is one to give.
That's correct.
Okay, great. All right. Any other questions that I didn't address in the chat? I believe I have gotten to all of them. So with that being said, Joseph Coradino, the CEO and of Pennsylvania REIT. Guys, thank you so much for joining us today on the Benzinga Small Cap Conference. And
you're welcome, and happy holidays, and go shopping.
All right. Yeah. You'd like that, wouldn't you? Yeah. Have a good one, guys.
Thank you.
All right. Oops, sorry about that. Okay. Real fast. What I wanted to plug before our next presentation is, if you haven't already, check out benzingaevents.com. All right. We are doing events all the time, some virtual, some in person, some like this, some a little bit different. Benzingaevents.com is where we keep our up-to-date calendar of all the things that we're doing. So, for example, you see the Global Small Cap Conference that's happening right now. You're watching it. Congratulations. Next week, we have our next All Access show. It's basically our one-on-one conversation show with me and some C-suite execs. And then December 29th, our final Benzinga boot camp of the year. These are one-day events that are like gung-ho on trading and investing education. So check it out, benzingaevents.com, to learn more. And you can see our whole calendar for 2022 is basically already done. Props to the events team. Getting things done early. We love it. We love it.